Hello, USMC Saxogi here. Today we're going to talk about mutual funds and ETFs and why performance is not as important as the fees that are charged for those ETFs and funds. So disclaimer before I begin, all these different funds, ETFs I'm going to show you, I do not represent the companies. I am not advocating for them. I'm not saying go buy them. I am not giving any financial advice. This is simply pattern recognition and the fact that you may think your fund is really awesome and doing really well, but when you do a little research and look into other similar funds, the majority of them are doing about the same. And I'm going to show you that via pattern recognition. And that's why fees are very important, because the returns on a lot of these funds are going to be the same. One thing that's going to change that is if they pay dividends and then what their fees are. And we're going to go over that. So in this video, to look at the different ETFs and mutual funds, I'm using Yahoo Finance. And what I did was I Googled ETFs and I Googled good performing mutual funds, and I went to Yahoo Finance and I entered their ticker symbol, which pulls up the fund, pulls up all the information, pulls up the charts, and I just did a little research about them. And this is what I came up with. So as you can see, we are still low tech on this channel. I just have my camera facing the computer screen. Anyway, so what we're looking at here is a number of funds. We're going to go over 6 funds and then 4 ETFs, okay? So the first one I pulled up, so I went to Yahoo Finance. You find out the ticker symbol, you type it into here, it'll auto-populate. And then you scroll down, and what you have is a nice summary of information. So for each of these funds, again, these are mutual funds and ETFs, I went to this screen here, the summary. You have all this information here, and I clicked on, for the chart, I clicked on the 1 year for all of these, just to give you an idea what I'm talking about. So this Thrive at Moderately Aggressive Allocation Fund, Class A, T-Max, as you can see, back in December 17th, it looks like it dipped to the lowest. And as the new year came in, it came up, dipped a little bit again there, came up, dipped again, and right there. And some of these are going to be red, some of them are going to be green. I think what that means is that Friday when the market closed, if they were up, they'll be green. If they were down, they'll be red. Okay. All right, so let's look at the next one. So again, I Googled, like for this one, I just Googled, what did I Google? Like best performing mutual fund September 2019. And then this popped up just to pull some. So this symbol right here, that's what you type into the Yahoo search bar on Yahoo Finance. Okay. So the Brown Advisory Growth, I don't know who that company is. It's another mutual fund. And so again, I went to the summary, I clicked on 1 year so that we're all the same time frame, and there you go. That's the summary. Are you seeing a pattern yet? Pretty much identical. A little differences here and there, but pretty much identical. Okay. You'll see the year-to-date return. That's kind of a fun number, but I don't really get too hung up on those things. So yeah, according to this fund's doing twice as good as the other one, but again, that doesn't mean anything. Pulled up VFIFX. It's the Vanguard Target Retirement 2050. And again, you notice a pattern here. December went down, came back up, dipped again, came back up, dipped, came back up. Again, there's a pattern here. Little differences, of course, because these funds have, what's the word? They're invested in different stocks, different companies. Okay, next one. What do we got here? Morgan Stanley Institutional Fund Incorporated. Growth Portfolio Class A. There's the ticker symbol. So this fund, this one looks a little different, but again, kind of the same pattern. We got a big dip in December, came back up, a little dip there, March 27th. Is that March 27th for everyone? Yes, okay. August 19th, dipped again. Where's old August 19th? There it is. And then this fund has continued down for, I don't know why. Doesn't mean it's a bad fund, doesn't mean it's a great fund. That's just what's going on. Let's see here. All right, moving on. So I think we're already seeing a pattern. So hey, this one was up when it closed apparently. So what do we got here? T. Rowe Price Tax Efficient Equity Fund, whatever that means. Again, I know about 10% about investing that I probably should know. It's a learning experience. So anyway, again, this is all public knowledge. Year-to-date return, 26.15. Hey, really good, look at that. But again, we see a big drop December 17th, then it climbs. Bam, went down March 27th, August 19th, and it continues on, okay? So I think we've established a pretty good pattern. This one, Vanguard 500 Index Fund Investor Shares. Index fund. Don't get too hung up on the price per share either, because that doesn't really matter. So, for example, if you invest $1,000 in this, you're going to get, what would that be, like 3 shares? 4 shares? 4 shares of that, 4 shares of some change. But you still invest $1,000. But if you invest $1,000 in, come on, load. In this fund, you would have a lot more shares, right? The only thing that's going to affect is when the share price does go up by, let's say, 5 cents, all your shares are going to increase by 5 cents. If you have more shares, you'll have a more increase, a greater increase. Yeah, you can see my reflection there. Isn't that neat? Hey, we're low tech here. All right, so I think we've seen a pattern. So again, the point of this video is that these are different funds. They're invested in different things. Most of them, and we'll double check this, most of them are 90% or greater in stocks, which means they invest in different companies, and you can see which companies they have the highest investments in. This is all transparent. This is no secret. So my little bit of advice to you right now is, if you have a 401k, with a company, that money is going into a fund or multiple funds somewhere. You just have to know what funds those are and go look them up on Yahoo Finance, essentially. Okay, where do we want to go from here? All right, let's go back and talk about fees. Okay, so you can check out all this stuff. It's really good. So click on profile. Yeah, you better still be recording. All right, click on profile. Gives you a bunch of information. Management information, Morningstar, style box. I'm not going to talk on this because I don't know enough to talk on it. It tells you a little bit about it. Fund summary. All right, so fund overview. Net assets, year-to-date return, yield, Morningstar rating, and I don't really care about that too much. Fund operations, holdings turnover, okay. All right, so fees and expenses. This is where you want to focus, okay? So annual report expense ratio, net. So this fund here, 1.12%. Prospectus net expense ratio, 1.12%. Gross expense ratio, 1.39%. Max 12B1 fee, 0.25%. Max front-end sales load, 4.5%. And then it gives you the expense projections. So this is what you want to focus on here. So if it's above, sorry, just bumped the camera there. The higher this number is, the higher these numbers are, obviously the more money you're going to get charged. So 10-year expense projection, $2,021. And I don't know exactly how fees, like these expense ratio fees, are taken out of your funds. I just inquired with Vanguard about that because when you make a trade on Vanguard, like a stock, like when you buy or sell stock, individual stocks, there's a $7 commission that's charged. It's very transparent. You see it right away. and it's charged you out of that transaction. But these expense fees, other than the front end sales load, you will see that when you invest money. The 12B1 fee, I don't even know what that is. I'll have to look it up later. But those annual report expense ratios, I don't know where that money's deducted. I just looked at some of my annual statements, and there wasn't any commissioner fees deduction. So I don't know where that money's coming from, but it's coming from somewhere. Okay. So this first one, these are the fees charged. All right, let's go to what was this one? Brown Advisory Growth, Equity Fund Investor Shares profile. All right. Okay. All right, so as you can see, the fees are much lower, okay? 0.86%. There's no 12B1 fee, whatever that is. There's no max front end sales load. That means when you invest $5,000, $5,000 will go into that account. And then the 3-year, 5-year, 10-year expense projection. Okay, so that one's lower. Next. Profile. Okay. Okay, this is why I like Vanguard. This is the Vanguard fund, all right. Annual report expense ratio, 0.15%. That's very low. There's no front-end sales load, and then no max deferred sales load, and then your 3-year, 5-year, and 10-year expense projection, very minimal. So if we go back to this one, $2021, $192. That's, you know, by the time you're ready to retire, that might be your monthly expenses, you know, that much money. So bear with me. I know this is boring, but I think it's informational. It's interesting. So this one here, this fund, Morgan Stanley, what do we got here? We got fees, 0.85, that's not bad, 0.25%. You want to see NA as much as possible, okay? So they will charge you 5.25% as a front-end sales load. What does that mean? That's essentially a commission. So if you invest $5,000 times 0.0525, that's the same as 5.25%. You will immediately see $262 gone, spent. So you're spending more for the same performance as a low cost fund, essentially. And that's the point of this video. Profile, we'll do one more, and we'll do 2 more. This one, okay, so no front end sales load, good. 10-year expense projection, kind of high. Look at another Vanguard fund. Again, I'm not saying buy Vanguard, go buy Vanguard. I would recommend it, but you invest money in the stock market, consider that money gone. There's a lot of risk. So again, Vanguard, very low expense, 10-year expense projection, $179. And then just moving on to ETFs, it's really the same story. I'm not going to go too much more in depth on ETFs. But as you can see, that's the point of this video. Your returns, the ups and downs of your funds are not as important as you think they are. And what do I mean by that? I mean that you could move your money into another fund that, hey, like your investment advisor, laser, your investment advisor, CPA, whatever, CFP says, oh, you should change your money over this one's doing really well. Well, it might be doing well better than the one you're in at the moment, but overall these funds are going to be very similar. It's a very similar pattern, and you could do 5-year max, and you're probably going to see very similar things. You can do the research on your own. Okay, this is all public information, public knowledge. You just have to have internet access. And again, different things. So that's why I say, and that's kind of the whole point of this video, that what was I going to say? That the fees that you're charged, the front end sales load, very important to watch, because if you don't know it, if you just throw your money at some financial planner you're gonna be losing money if you're not monitoring it. For example, one time I invested some money in a financial company, and I looked at my account, and it was $500, like around $500 less than what I invested. And I'm just like, what the fuck? Well, that front end sales load, they got me. And there's probably fees on top of that. For actively managed funds, you get charged fees every time there's a trade. So my advice is, unless you've got millions of dollars, you should be able to manage your funds and invest where you want to invest yourself, because all the information is there. It just takes a little bit of time to research. What was the ultimate point of this video? This video was to show you that day-to-day performance or yearly performance or monthly, quarterly performance for mutual funds, ETFs, for the average investor are not as important as the fees that you are being charged. Just by showing you what I showed you, they all go up or down at about the same time based on the market. So there's not much advantage to paying somebody to actively manage your funds for advice you doing it yourself and paying them exorbitant fees that cost you thousands, hundreds of thousands of dollars by the time you're ready to retire. It's your money, it's your retirement, and when you give your money to somebody and say, handle it for me, that means you don't care about your money and you don't care about your future. So take, take responsibility for yourself, for your actions, and be smart with your money, okay? Thanks. Oh yeah, all seriousness aside, don't forget to have fun. Investing in individual stocks, not ETFs, not mutual funds. Investing in individual stocks is legalized gambling. If you have a little play money and you want to take on a little risk, go have fun. Go invest in a company you really like. I don't know, whatever, Uber, freaking Facebook, whatever. Go find a company you like, put some money in the stock market, and see what happens. You might lose it all, you might double it, you might make a little bit, or it might do nothing. But don't be afraid to have a little fun in the stock market, because it is fun. There's nothing worse than seeing your money disappear, and there's nothing better than seeing it grow. So that's just my little piece of advice. As always, I am USMC Sachs Okie. Thanks for watching. Please like and subscribe. I've got a lot of good thoughts, a lot of good information, and I will see you next time.